Folks, this just in. It appears that Warren Buffett has struck a deal to trade jobs with daytime soap opera diva Susan Lucci. Buffett has reportedly negotiated a permanent spot on the cast of All My Children. Apparently, Ms. Lucci is en route to Omaha as the new CEO of Berkshire.
Where could he be?
Do you mean Warren, Charlie? He's been detained at the TV studio.
Really?
Hi, Charlie. I'm Susan Lucci. Oh, haven't you heard about the deal between Warren and me? He's going to be a big star at All My Children, and I'm going to be taking over Berkshire Hathaway.
Well, you've certainly got some important qualities that Warren lacks.
Well, thank you, Charlie. And you can relax now, you dear man. You just make yourself at home, because I'll take it from here, thank you. I've been wanting to talk to our shareholders for quite some time now. There's some changes I really think we need to make around here. The first thing we need to look at is our dividend policy. I have never heard of anything so cheap and so unfair to our wonderful shareholders. We need to change it.
Sounds good to me.
And second, we need to look at giving guidance on earnings. And we need to do that every single week.
Sounds good to me.
And third, we need to pay our directors more than $900 a year.
One minute.
Hi, Warren. Warren, I thought you were at the All My Children studio.
What's that talk about dividends that I hear?
Oh, nothing important, Warren. You just concentrate on your role on the show.
Susan, my show is Berkshire Hathaway, and my role is to run it.
Warren, you can't do that.
I just did it. All My Children can't do without you, and I can't do without Berkshire.
Oh, Warren. So you mean the deal is off?
The deal is off. I really want to thank you. You've brought me to my senses. You can go back to All My Children. I'll stay here at Berkshire. But I am so grateful to you, Susan, that I want you to go out to Berkshire, out to Borsheims, and I want you to pick out anything you would like and charge it to Charlie.
Oh, Warren, you are a darling. Thank you. You're a darling, too.
Now, wait a second.
A very good morning to Mr. Buffett and Mr. Munger. My name is Rajesh Vora from Bombay, India. I have been learning a lot from annual letters of yours. It's been a great insight into investment philosophy that I haven't learned from anywhere else. Great job. That's on the mind side, but on the heart side, what touches me the most is what you have achieved all these years is through 100% honesty, and I salute to that. Thanks. My question is on what key steps would you recommend to correct the mindset of typical investor like me, which is what you narrate as lemmings-like, the crowd mindset?
What would we recommend? We got the question being repeated here. About the mindset of an investor, is it?
He wants you to advise him as to how he can become less like a lemming.
Well, since you repeated the question, I'm going to let you give the first answer to that, Charlie. Until he eats about 1,000 calories a day. Well, I will tell you what changed my own life on investing. I started investing when I was 11. I first started reading about it. I believe in reading everything in sight, and first started reading about it when I was probably 6 or 7 years old. But for about 8 years, I wandered around with technical analysis and doing all kinds of things, and then I read a book called The Intelligent Investor. And I did that when I was 19 down at the University of Nebraska. And I would say that if you absorb the lessons of The Intelligent Investor, mainly, and I wrote a foreword and I recommended particularly chapters 8 and 20, that you will not behave like a lemming, and you may do very well compared to the lemmings. We have here in the bookworm copies of The Intelligent Investor, and I think it's as great a book now as I did when I read it early, I guess, in 1950. You can't get a bad result if you follow the lessons of Ben Graham taught in that book. I should mention that there's a book out there also that I did not know it would be completed by this time. My cousin Bill Buffett has written a book about our grandfather's grocery store called Food You Will Enjoy, and Bill will be out there. He's signing books. I just got my first copy a couple of days ago, read it, and I enjoyed it a lot. Charlie worked at the same grocery store. How many years ago? Probably a good 70 years ago in Charlie's case. Neither one of us was very good. But my grandfather, you don't want to pay much attention to his advice on stocks. He wrote a lot of letters, and he was very negative on the stock market and big on hard work at the grocery store, so we quit listening to him. Instead, read The Intelligent Investor. That's the book that gave me a philosophy that has taken me now for a lot of years, and there's 3 big lessons in there which relate to your attitude toward stocks generally, which is that you think of them as parts of a business, and your attitude toward the market, which is that you use it to serve you and not to instruct you, and then the idea of a margin of safety, of always leaving some extra room in things. But the people in this room, I think, have learned that important first lesson. I mean, I think most people that own Berkshire do not see themselves as owning something with a little ticker symbol or something that may have a favorable or unfavorable earnings surprise or something of the sort, but they rather think of themselves as owning a group of those businesses that are out there in the other room. And that's the way to look at stocks. You'll never be a lemming if you do that. Let's go to number 2.
Good morning, Mr. Buffett, Mr. Munger. My name is Sam Reiner from Fort Lee, New Jersey, and my question concerns your comment this week about the recession and the stock market going up so significantly in April. Can you expand on where the market's going from here?
Well, I could expand, but I couldn't answer. Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. You know, it never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business. Obviously, if we could guess successfully a high percentage of the time where the stock market was going to go, we would do nothing but play the S&P futures market, where there wouldn't be any reason to look at businesses and stocks. So it's just not our game. We don't think what we see when we look at the stock market is we see thousands and thousands and thousands of companies priced every day, and we ignore 99.9% of what we see, although we run our eyes over them. And then every now and then we see something that looks like it's attractively priced to us as a business. Forget about the word stock. So when we buy a stock, we would be happy with that stock if they told us the market was going to close for a couple of years. We look to the business. It's exactly the same way as if you were going to buy a farm a few miles here outside of Omaha. You would not get a price on it every day, and you wouldn't ask, whether the yield was a little above expectation this year or down a little bit. You'd look at what the farm was going to produce over time. You'd look at the expected yields. You'd look at expected prices, the cost, taxes, the cost of fertilizer, and you would evaluate the intelligence of your purchase based on what the farm produced relative to your purchase price. Quotes would have nothing to do with it. That's exactly the way we look at stocks. We look at them as businesses. We make judgments about what the futures of those businesses will be, and if we're right about that in those judgments, the stocks will take care of themselves. Charlie?
Nothing to add.
He's been practicing for weeks. Let's go to area 4.
Good morning, Mr. Buffett and Mr. Munger. My name is Chandra Chawla, and I am from Seattle, Washington. Berkshire Hathaway has some of the best managers in the world, and I am very bad at hiring good managers. Some of the decisions I've made, which were without any phone calls from Jamie Lee Curtis, I look back and I see, what was I thinking? So what can you advise on how in 1 hour you can assess the capability of a person to be a good manager?
Well, you have to understand that we cheat. We buy businesses with good managers. So if you give me 100 MBAs, and I have these classes come out all the time. I've had about 30 schools this year, and usually there's 75 or 100 men and women in the classes. I no more could take those 100 and spend a few hours and rank them from number 1 to 100 in terms of their future achievements as managers, then I could pick them. It would be impossible for me. But what we do is we buy businesses with great managers in place. We've seen those people perform for, in many cases, decades. We've seen their record, and they come with the business. Now, our job is not so much to select great managers, because we do have this proven record that they come with. Our job is to retain them. And many of the managers, the majority of the managers that work at Berkshire, are independently wealthy. We hand them checks, sometimes in the billions, often in the hundreds of millions. So they do not have a monetary reason to work in many cases. So our job, we are dependent on them, incidentally. I mean, we have 19 or so people at headquarters, and we have 250,000 working for Berkshire around the world. And we can't run their businesses. And our job is to make sure that they have the same enthusiasm, excitement, passion for their job after the stock certificate changes hands than they had before. Now, that requires some judgment on our part as to whether these people love the business or love the money. Now, they all like money, but many of them, our managers in particular, they love their businesses. I mean, they've worked at them. They're a work of art to them, and they've been in the family sometimes as many as 4 generations. So we have to see the passion in their eyes, and if we see that, then we have to behave in a way that passion remains. Can't be done by contract. We don't have contracts. That doesn't work. But we can try to create an environment, and Berkshire, frankly, is the ideal environment. It's even an ideal environment because of events like this. Our managers feel appreciated, and they are appreciated. And they're not just appreciated by me and Shirley. They're appreciated by you. and we want to give you a chance to applaud them. So I can't be of enormous help if you're looking at a group of MBAs. You know, it's not easy. I mean, they sort of learn by that point in life how to fool you in terms of what answers you want to hear and all of that sort of thing. I would look for the person with passion for the job. I mean, the person that is always doing more than they're sure. You look for people that are good communicators and all of that sort of thing. But I like my way better. It's a lot easier just to take somebody that's been batting 400 in baseball and say, I think I'll stick him in the lineup. And the nice thing about our game is that, you know, in baseball, unless you're Nolan Ryan or somebody, you have to hang up things at 40 or thereabouts. But in our game, they go on and on and on. I mean, I use as an example, we had a famous Mrs. B from the Furniture Mart, and she worked for us till she was 103. And then she left and she died the next year. And that is a lesson to our managers that Charlie?
Well, that was very useful advice. It reminds me very much of the late Howard Amundsen, and a young and starving business student once asked him for advice as to how to get ahead. And Howard said, well, I always keep a few $1 million lying around in case a good opportunity suddenly turns up.
Well, let's go to number 5.
Good morning. I'm Joe Hudson, a shareholder from Culver, Indiana. Could you please comment on how you use stock options when trying to enter or exit a position in a public company?
Yeah, I think there was one time we sold a put on Coca-Cola with the idea that if it got exercised, we were very happy to own more Coca-Cola. It didn't get exercised. We would have been better off if we just bought the stock. Usually, if you want to buy or sell a stock, you should buy or sell the stock. And using an option technique to buy a call on a stock instead of buying the stock outright with the idea that you get it a little cheaper that way means that about 4 times out of 5 you'll be right, and the 5th time the stock will have moved earlier, and you'll have missed, you know, the transaction you wanted to have. And so we virtually have never used options as a way to enter a position or exit a position, and I would doubt very much if we do. We've sold these long-term equity put options that are described in the press release yesterday and were described in the annual report, but that's a different sort of thing. If we want to buy something, we'll just start buying it, and if we want to get out of it, we'll start selling it, and we won't get involved in any fancy techniques. Charlie?
Well, if I remember right, you wrote a letter when the public authorities were deciding whether we should have option exchanges for stocks. And Warren was all alone at that time, and he wrote a letter saying that he didn't think it would do any good at all for the country to throw out the margin rules in this fashion. I've always thought that Warren was totally right. It's the idea of turning financial markets into gambling parlors so the croupiers can make more money has never been very attractive to us.
Yeah. Yeah, it's very interesting to me when I talk to these MBA students. One of them from the University of Chicago, the very first question I got a few years ago, he says, what are we being taught that's wrong? I love questions like that. I have to plan them in the future. The amount of time spent at business schools, maybe it's a little less now, but teaching things like option pricing and that sort of thing, it's totally nonsense. I mean, you need 2 courses in a business school. One is how to value a business, and how to think about stock market fluctuations. But the idea that you would spend all of this time with formulas, but the problem, of course, is that the instructors know the formulas, and you don't when they come, and so they've got something to fill the time explaining to you. And, you know, it is no fun if you were teaching biblical studies, and you could read 3 or 4 of the most important religious tomes forward and backward in 5 different languages, you would hate to tell somebody that it all comes down to the 10 Commandments. I mean, any damn fool can do that. So there's a great desire of the priesthood in finance to want to teach the things that they know and you don't know, and that they spend a long time learning, and that maybe require a fair amount of mathematics. And it really has nothing to do with investment success. Investment success depends on buying into the right businesses at the right price. And you have to know how to value businesses, and you have to have an attitude that divorces you from being influenced by the market. You want the market there not to influence you. You want it there to serve you. And that requires a mindset, which goes back to an earlier question. And it's a mindset that's described quite well in Chapter 8 of The Intelligent Investor. Let's go to number 6.
Good morning. My name is Mark Rabanov from Melbourne, Australia. My question is, Berkshire has bought a lot of shares over the last 12 months in listed companies. Do you expect the return on these investments to be between 7 and 10% per annum over many years, which is, I would say, well below what Berkshire has achieved in the past?
The answer to that is yes. We would be very happy if we could buy common stocks where our expectation over a long period pre-tax from a combination of dividends and capital gains, we'd be very happy if we thought it was going to be 10%. And we would probably settle for a little less than that. And there's no question, absolutely no question, that returns from owning Berkshire will be less in the future than they have been in the past. There's no question that we will not do as well with the common stocks at Berkshire that we own in the future as we have over the last really 40 years or thereabouts. We operate now in a universe of marketable stocks where we're talking about companies with market caps of at least 10 billion. In most cases, to have a meaningful impact on Berkshire, we're talking much bigger than that, maybe 50 billion and up. Well, that universe is not as profitable a universe to operate in as if you have the entire universe of thousands and thousands of companies. So if we just take an example, if we find a company with a market cap of 10 billion and we can buy 5% of it, and usually that's about what we can buy without disturbing things, we can have a $500 million investment. Let's say it doubles over a period of time. That's 500 million. You pay a 35% tax. You have 325 million. That's less than 0.2% in terms of Berkshire performance. So our universe has shrunk enormously, and we will not do as well in that universe remotely as well as we would if we were operating in a much wider universe and could do all kinds of things. We've found little things to do from time to time where we've made some money. I may refer to them a little later, a couple of things. And they're nice, but they don't move the needle very much at Berkshire. So anyone that expects us to come close to replicating the past should sell their stock. I mean, because it isn't going to happen. And, I think we're going to get decent results over time, but we're not going to get indecent results. And in this field, we prefer indecent, but we're not going to get them. Charlie?
I think you can take Warren's promises to the bank. We are very happy making money at a rate in the future that is way less than the rate at which we made money in the past. And I suggest that you adopt the same attitude.
Well, I wouldn't condemn him to that. I think if you're working with small amounts of money, I've talked to then you may have something very much better to do with your money than to buy Berkshire. I mean, if you're working with small amounts of money and you want to put in significant amounts of time and examine thousands of securities, you will find things that are more intelligent to buy than Berkshire. We still think Berkshire is an attractive investment over a long period of time. We think that it stacks up reasonably well with other very large companies. We don't think it's the most attractive investment in the world in terms of what you can find if you're willing to go through those thousands of possibilities, which is what Charlie and I used to do many years ago. It's not feasible for us to do it now, and it wouldn't have any impact on Berkshire. What we really like at Berkshire is buying good-sized to very large first-class businesses with first-class management and just sitting there. Because the nice thing about that is you don't have to go from flower to flower. You can just sit there and watch them produce more and more every year and give you capital, and you can buy more businesses. That's a nice formula. It's a formula that will work, I think, for us. It won't produce returns like the past. Number 10.
Good morning. I'm Dinesh Kakaria from Walnut Creek, California. Well, we learned something from a comic movie, but could you please expand on how do you maintain your good mental and physical health?
Well, you start with a balanced diet. Some Wrigley's, some Mars, some C's, some Coke. Oh, basically, if Charlie and I can't have a decent mental attitude, who can? I mean, we get to do what we love doing every day. We do it with people that are not only cheerful about it and like us, but they do their jobs extraordinarily well. They like their jobs too. We're forced to do virtually nothing that we don't want to do. I have a trainer that comes 3 times a week. I think she's probably here. She may think I'm a little begrudging in that particular activity, but that's only 45 minutes 3 times a week. And the rest of the time, I am doing I'm doing whatever I love day by day by day by day, and I do it, in air-conditioned offices and with all kinds of help. I mean, how could you be sour about life, being blessed in so many ways? And then the amazing thing is that when Charlie's 84, I'm 77, there's just no reason to look at any minuses in life and to focus on that. It would be crazy. So, we really do count our blessings because they've been many, and they continue to come forth, and we'll enjoy it as long as we can. There's not much more to it than that. Charlie?
Well, I wish we were poster boys for the benefits of running marathons and maintaining a very slim bodily state and so forth. But as nearly as I can tell, neither of us pays much attention to any health habits or dietary rules. And it seems to have worked pretty well so far. I don't think we can recommend it to everybody, but I, for one, don't plan to change.
Really, from the moment we get up to when we go to bed at night, we get to do all kinds of things. We get this associating with wonderful people is about as good as it gets, and we're biased, obviously, but we think we live in the best country in the world and have all kinds of good things. I mean, just imagine. Well, we could have stayed in my grandfather's grocery store and it would have been hell.
Hi, I'm Richard Rantrop from Bonn, Germany. At the moment I attend high school and would like your wisdom on how to approach the question of what to do with the rest of my life. So,
we prefer things a little more difficult than that, if you've got to say.
So, Mr. Buffett, Mr. Munger, if you were about to start all over again, what profession would you choose and why?
Well, I would choose what I do because A, I have fun at it. I'm reasonably good at it. I meet a lot of interesting people through it. No heavy lifting. It fits me. But that's not advice for you. I mean, you have to find out what's your passion in life. It's a terrible mistake to kind of sleepwalk through your life, because unless Shirley MacLaine's right, it's the only one you're going to have. And so I was very lucky in that I found my passion early. I mean, that's not easy. That takes some luck. It just so happened my dad was in a business, had a very small office, and he had a bunch of books down there. And when I would go down there on Saturday or after school, I would start reading those books, and it turned me on. And this was before Playboy actually existed. And so, that was just plain lucky. If he'd been a minister, I'm not so sure I would have gotten quite as enthused about visiting the office. But that's the way to, and I can't prescribe that for you. But I can tell you that if you're going through the motions in life, you're doing something. Now, obviously, if you need the job you have and you can't make a change, and your kids have to eat and all of that, you deal with realities like that. But when you're in a position to make choices, I always tell the kids that come visit me, I tell them, go to work for an organization you admire or an individual you admire. That means that many of them become self-employed, but but the idea, you can't get a bad result. I went to work for Ben Graham when I was 24. I only worked for him for less than 2 years. But I jumped out of bed every day in the morning. I was excited about what I was going to do. I was learning things. I was with a man I admired. I never asked my salary when I took that job. I moved to New York City and found out what my salary was when I got the check. So just be sure you get the right spouse. That's enormously important. As Charlie says, the problem, is that we talk about that fellow that spent 20 years looking for the perfect woman, and then he found her, and unfortunately she was looking for the perfect man. So you may have a problem in that respect. But it's enormously important who you marry. I mean, it's a huge, huge, huge decision. And if you're lucky in a couple of things like that, you're going to have a happy life, and you're going to behave better as you go along. I mean, it's a lot easier to behave well when things are going your way and you're enjoying your work, and you're thinking about things every day that are the kind of things you like to think about. And Charlie has a lot better advice than I have on that. Go to it.
Well, of course, you'll do better if you develop a passion for something in which you have a considerable aptitude. I think if Warren had gone into the ballet, nobody would have ever heard of him.
Oh, I think they'd have heard of me, just in a different way, Charlie. Well, the chances are, if you find something that turns you on, you probably do have some talent for it, though. I mean, I don't think I could have gotten turned on by ballet.
I'm Nancy Ankowitz. I'm from New York City, and I teach at New York University. Mr. Buffett, I'd love to get your advice on something that's a little off the investing path, but that taps into your business experience and wisdom. I'm writing a book to help people of a more introverted nature get the recognition they deserve. What advice would you give to the quieter half of the population to help them raise their visibility in their careers?
Well, that's a very good question, and I sort of faced that at one time. I was absolutely, throughout high school and college, terrified of public speaking. And I avoided any classes, signing up for them that would require it. I would get physically ill if I even thought about having to do it, let alone doing it. And I took a Dale, first of all, I signed up. I went down to a Dale Carnegie course when I was at Columbia and signed up for it, gave him a check for $100, went back to my room and stopped payment on the check. This is a real man of courage you're looking at up here. And then I came out to Omaha, and I saw a similar ad. I was at the Rome Hotel for you old-timers in Omaha on 16th Street, and I went down there. And this time I took $100 in cash and gave it to Wally Keenan, who some of you may know. He died some years ago. First time I'd met him. And I took that course, and when I finished that course, I went right out of the University of Omaha and volunteered to start teaching, knowing that I had to get up in front of people. I think the ability to communicate both in writing and orally is of enormous importance, undertaught. Most graduate business schools, they wouldn't find an instructor to do it because it would sort of be beneath them to do something so supposedly simple. But if you can communicate well, you have an enormous advantage. And to you who are talking to the group of introverted people, and believe me, I was in certain ways quite introverted, it's important to get out there and do it while you're young. If you wait till you're 50, it's probably too late. But if you do it while you're young, just force yourself into situations where you have to develop those abilities. And I think the best way to do that is to get in with a whole bunch of other people who are having equal problems, because then you find you're not alone and you don't feel quite as silly. And of course, that's what they did at the Dale Carnegie course. I mean, we would get up in front of 30 other people who could hardly give their own name, and after a while we found out we could actually pronounce our own name in front of a group. But we would stand on tables and do all kinds of silly things just to get outside of ourselves. And you may have thought it, by this point you may think it went too far in my particular case, but that's another problem. But you're doing something very worthwhile if you're helping introverted people get outside of themselves and working with them in groups where they see other people have the same problem and they don't feel quite as silly themselves. I think you're doing a lot for some human beings when you help them do that. Charlie?
Yeah, it's a real pleasure to have an educator come who is working to do something simple and important instead of something foolish and unimportant.
I hope he's not going to name names. Okay, let's go back to number one.
Hi, my name's Henry Patner. I'm hailing from Singapore most recently. In one of your older letters, your older partnership letters in 1964, you introduced a fourth investment method called Generals Relatively Undervalued. In your description, you say, "We have recently begun to implement a technique which gives promise of very substantially reducing the risk from an overall change in valuation standards. We buy something at 12 times earnings when comparables or poorer quality companies sell at 20 times earnings, but then a major revaluation takes place so that the latter only sell at 10 times. Is this technique pair trading? And if so, how did you think about and calculate the ratio of longs to shorts?"
Yeah, I didn't remember we started as early as 64, but certainly in the 60s we did some of what in a very general way would be called pair trading now, which is a technique that's used by a number of hedge funds and perhaps others that go long one security and short another, and often they try to keep them in the same industry or something. They say that British Petroleum is relatively attractive compared to Chevron or vice versa, so they long one and short the other. And actually that technique was employed first by Ben Graham in the mid-1920s when he had a hedge fund. Oftentimes, I read articles all the time that credit A.W. Jones with originating the hedge fund concept in the late 40s. But Ben Graham had one in the mid-1920s, and he actually engaged in pairs trading. And he found out it worked very modestly well, because he was right about 4 times out of 5, but the time he was wrong tended to kill him on the other 4. We shorted out the general market for about 5 years in the partnership to a degree. We borrowed stocks directly from some major universities. I think we were probably quite early in that. We went to Columbia and Harvard and Chicago and different places and actually arranged for direct borrowing. It wasn't as easy to facilitate in those days as it is now. And so we would take their portfolios and we would just say, "Give us any of the stocks you want to, and then we'll return them to you after a while and we'll pay you a little fee." And then we went long things that we thought were attractive, we did not go short things that we thought were unattractive. We just shorted out the market generally. It was always kind of interesting to me when I would visit the Treasurer of Columbia or something like that. And I'd say, we would like to borrow your stocks to short. And, he thought his stocks were pretty good at that point. And he'd say, well, which ones do you want? And I said, just give me any of them. I'm happy to short your whole damn portfolio. I needed the Dale Carnegie course to get me through that kind of thing. We didn't have any specific ratios in mind. We were always limited by the number of institutions that would give us the stocks to short. So it was not a big deal, but we probably made some extra money out of it in the 60s. It's not something that would fit what we do these days at all. And generally speaking, I think if you got some very good ideas on businesses that are undervalued, it's really unnecessary to do any shorting out of the market. For those of you who are in the field, I mean, there's a kind of a popular proposal. Money managers always have some popular proposal that's being sold to the potential investors, and now there's something called 130-30 where you're long 130%, long short 30%. That stuff's all basically a bunch of stuff just to try and sell you the idea of the day. It doesn't really have any great statistical merit, but the fish bite, as Charlie says. And Charlie can elaborate on that.
Yeah, we made our money by being long some wonderful businesses. We didn't make it by a long-short strategy.
Number 3.
Dear Mr. Buffett, dear Mr. Munger, my name is Oliver Krautscheid from Frankfurt in Germany. The subprime crisis has led to inconsistent pricing in capital markets. Credits are trading at large discounts, and at the same time, the equities do not reflect this. My question is, when will this be over, and how do you take advantage of market dislocations?
Well, when there are market dislocations, there are always ways to take advantage of it, but we'll leave for you the joy of searching for those. But there have been some really important dislocations, and I brought along, just for your amusement, a few figures on something that we've done recently, but it doesn't have any big significance for Berkshire. I mean, and you find those occasionally. You found that after the long-term capital management crisis in 1998. You found the equivalent of it in the stock market in 1974 and so on. And those are great times to make unusual amounts of money. And there's certain things we can't figure out. I see in the Wall Street Journal, I see advertisements these days of auctions taking place in some esoteric mortgage securities. If you had enough time, you could probably figure out some of those that were very mispriced. We don't fool around with that. We just don't have the time. We were able to do we have about $4 billion in this right now. When we get all through, we'll have made some extra money for a couple of months. It won't be significant in relation to Berkshire's size, but it's something that's very easy to do. You may be able to find, by working very, very hard on some smaller issues, you might be able to find in this mess in mortgages, and it's gone beyond subprime. It's gone into all-days, and it's gone into option arms and that sort of thing. There very well could be some great opportunities out there that Charlie and I will no longer spot because we just can't be looking at that many things. Charlie?
Yeah, what is interesting is that how brief these opportunities to take advantage of dislocations frequently are. Some idiot hedge fund bought unlimited municipal bonds at, incredible margins. I think they bought 20 times more municipal bonds than they could afford with their own money, borrowing all the rest. And when those things were dumped on margin calls, municipal bonds suddenly got mispriced in America. But the dislocation was very brief.
But very extreme.
But very extreme. And so if you can't think fast and act resolutely, it does you no good. So you're like a man standing by a stream trying to spear a fish, and the fish just comes by once a week or once a month or once every 10 years. And You've got to be there to throw that spear fast before the fish swims on. It's a pretty demanding business if you do it right.
But there have been times, I mean, in the junk bond market, there was a 3 or 4 month period in 2002 where some really incredible things happened, and they happened on a large scale. So,
yeah, it happens about twice a century.
Yeah. Which means that he and I have only had 4 or 5 times when we could do it. Let's go to number 4.
Hello, Mr. Buffett and Mr. Munger. My name is Srinivas Kanediwal. I am from Fort Lauderdale, Florida. I read all your letters and annual reports multiple times, and every time I get a different insight, so thanks for doing it. My question is about converting the successful small businesses into large enterprise. I have a good and successful small business. From the last few years, I'm unable to grow it to the next level. It seems like there are some components I'm missing, so wanted to take your advice on it.
Well, Berkshire was a small business at one time. I mean, it just takes time. I mean, it's the nature of compound interest, and you know, you can't build it in one day or 1 week. So, Charlie and I have, you know, we have never tried to do in some master stroke convert Berkshire into something 4 times as large. People have done that sometimes in business, but it'd be nice to attract a whole bunch of money into some great idea you have and, you know, multiply it many-fold in a few weeks or something of the sort. But that has really not been our approach. We have done, in a general way, we've done the same thing. Now we do little variations of it, but we've kept doing the same thing for years, and we'll keep doing it. You know, we will have more businesses a few years from now than we have now, and we'll have all the ones we have presently. Most of them will do better, some won't, and we will have added something, and that's an automatic formula for getting ahead, but it's not an automatic formula for galloping ahead. But we don't really feel, we're not unhappy because we're not galloping. We're unhappy if we're not moving at all. But, you know, we've got 76 or so, in most cases, pretty darn wonderful businesses. And like I say, we'll have more as we go along. So it's a very simple formula. Gypsy Rose Lee said once, she said, I have everything I had 5 years ago. It's all that it's 2 inches lower. You know, well, what we want to have 5 years from now, a whole bunch of businesses we had before that are 2 inches higher, plus some more businesses. And that's the formula. Charlie?
Well, yeah, you got to remember that it's the nature of things that most small businesses will never be big businesses. It's also in the nature of things that most big businesses eventually fall into mediocrity or worse. So it's a tough game out there. In addition, the players of the game all have to die, and those are just the rules of the game, and you have to get used to it. We've only created from scratch one small business that became a huge business that I can think of, and that's the reinsurance department. And there, Warren and Ajit and others have created a great and valuable business out of air. But can you think of anything other that's large that we've done in all these decades?
No.
We've only done it once, so we're a one-trick pony.
Yeah, we were lucky on that one, too. Yeah, and incidentally, without a G, we wouldn't have done it at all. So,
right.
It isn't that we did it. A G did it. We just sat there cheering.
Somebody asked us once what was the best investment we ever made, and I answered, the fee we paid to the executive recruiter to find Ajit Jain.
Hello, my name is Stuart Kay, and I'm from New York City. I wanted to know if you could not talk with management, could not read an annual report, and did not know the stock price of a company, but were only allowed to look at the financial statements of a company, what metric would you look at to help you determine whether you should buy a company?
Well, what we're doing in investment, and what everybody is doing in investment, is they're laying out money now to get more money back later on. Now, let's leave the market aspect of the asset out. I mean, when you buy a farm, you really aren't thinking about what the market on it's going to be tomorrow or next week or next month. You're thinking about how many bushels of beans per acre can you get, or a corn per acre, and what the price is likely to be. You're looking to the asset itself. And in the case you lay out, the first question you'd have to make is, do I understand enough about this business so that the financial statements will tell me the information that's useful to me in making a judgment about what those future financial statements are going to look like? And in many cases, the answer would be no. Probably in a great majority of the cases, it would be no. But I've actually bought stocks the way you're describing many times, and they were in businesses that I thought I understood, where if I knew enough about the financial past, it would tell me enough about the financial future that I could buy. Now, I couldn't say the stock was worth X or 105% of X or 95% of X, but if I could buy it at 40% of X, I would feel that I had this margin of safety that Graham would talk about, and I could make a decision. Most times I wouldn't be able to make it. I wouldn't know. If you hand me a bunch of financial statements, you don't tell me what the business is, there's no way I can make a judgment as to what's going to happen. It could have been a hula hoop business. It could have been a pet rock business. On the other hand, it could have been Microsoft early on. So unless I know the nature of the business, the financial statements aren't going to tell me much. If I know the nature of the business and I see the financial statements, if I see the financial statements on Wrigley, I know something about the business. Now I have to know something about the product before I can make that judgment. But we've bought lots and lots of securities, Charlie. The majority of the securities Charlie and I have bought, we have never met the management and never talked to them. But we have primarily worked off financial statements, our general understanding of business, and some specific understanding of the industry and the business we're buying. Charlie?
Yeah, I think there's one metric that catches a lot of people. We tend to prefer the business which drowns in cash. It just makes so much money that one of the main principles of owning it is you have all this cash coming in. There are other businesses, like the construction equipment business of my old friend John Anderson. And he used to say about his business, you work hard all year, and at the end of the year, there's your profit sitting in the yard. There was never any cash, just more used construction equipment. We tend to hate businesses like that.
Yeah, it's a lot easier to understand a business that's mailing you a check every month. But that's what an apartment house is. If you own you can probably value an apartment property pretty well if you know anything about the city in which it's in, and if you have the financial statements, you can make a reasonable guess as to what the future earnings are likely to be. But that's because it is a business that gives you cash. Now there could be surprises in that arena as well. But I bought a lot of things off financial statements. There are a lot of things that I wouldn't buy, if I knew that. Actually, there are a lot of businesses I wouldn't buy if I thought the management was the most wonderful in the world, because they were in the wrong business. It really doesn't make much difference. Number 6.
Hey, I'm Jack Ringe. I'm from Philadelphia. I'm in 7th grade, and I'm 12 years old. I just wanted to ask, what kind of things should I be reading, in my grade? Because I know there are a lot of things that they don't teach you in school that you should know. But what things should I be looking into?
Well, I would get in the habit, if you don't have it already, but you sound like you very well may, of reading a daily newspaper, which is not the most popular thing in the world among younger people these days. But you want to learn as much as you can about the world around you. And Bill Gates, I think, quit the letter P in the World book. Doesn't seem to have hurt him too much to quit there. But you ought to have a set of. You can have a set of world books. You can read the newspapers. You should just sop it up, and you'll find out what's the most interesting to you. I mean, there's a certain point where the sports pages are most interesting to me, and then the finance pages. And I happen to be a political junkie, but you just can't learn enough in life. And I think what you'll find is that the more you learn, the more you want to learn. I mean, it is fun. But you sound to me like a young person that's going to do a lot of that on their own. Do you have any suggestions, Charlie? You'd probably suggest reading Ben Franklin.
Well, my suggestion would be that the young person who just spoke has already figured out how to succeed in life. You've got it made.
Greetings to all of you from the Midwest of Europe, from Bonn, Germany, on the Rhine River. I'm Norman Rentrop. I'm a shareholder in Berkshire, Wesco, and Cologne Re. I want to thank you and Ethan Wertheimer to take the initiative and the time to come to 4 cities in Europe and potentially throughout the world to tell owners of family businesses what great alternative Berkshire Hathaway is to selling their businesses to buyout funds. Now my question regarding the chocolate industry. I'm challenged since I cannot buy See's candy in my hometown, Bonn, Germany. You gave that great example of the great business, the good business, and the gruesome business. See's candy, you cited having sent like $1.3 billion in cash profits to Omaha. There's another company called Lindt & Sprüngli. Now, while See's candy achieves more than 20% profit on sales, you describe that their growth has been okay. Lindt & Sprüngli does only 14% on sales, but they did go almost global.
Yeah, could you get to the question, please, on this?
Yeah. The question is in whether you want to have a company with high profitability but okay growth versus a company going global but lower profits. What are your considerations?
It really makes no difference to us. We evaluate all kinds of businesses, and what we do want is we want a business with a durable competitive advantage, which both of the companies you named do. And we want something we understand, and we want a management that we like and trust, and then we want a price that makes sense. And we try to look at, we probably looked at every confectionery business, for 20 years that publicly owned, where we get the figures, and sometimes we find something where we can take action, and most of the time we don't. When they're private businesses, we don't determine, a really good private business. I always tell the manager the best thing to do if you got a wonderful private business is just keep it. It's going to be worth more next year and the year after. So there's no reason to sell a wonderful business except for kind of extraneous factors. It may be family situations, it may be taxes, it may be that there isn't another potential heir or whatever it may be. But there's no need. If you've got a business worth $1 billion, you don't need the $1 billion. You've got a business that's worth $1 billion any more than if you've got a farm that's worth $1 million. You've already got the $1 million. You just happen to have it in the farm. And if you like farming, you keep it. So we never urge people to sell the businesses. We urge them to keep them. But there comes times when they do want to sell for one reason or another, maybe once every 20 or 50 years. And we do think if they have a business that they're enormously proud of, it's a really fine business, that they can keep more of the attributes that they love in that business by selling it to Berkshire than they can by far selling it to anyone else. So we are the logical buyer. As you mentioned, I'm going to Europe. Eitan has been wonderful about setting this up, and we're going to make presentations, not to try and get anybody to sell us their business now, because most people shouldn't sell us their business now. But we do want them to think of us when the time comes, when an event occurs that does cause them to think about selling. And we want to be on their radar screen. And we're more on the radar screen in the United States than we are in Europe, and we're going to try to correct that. But if you take a firm like you name and Lindt, there's a price at which we would buy stock in Lindt. There's a price at which we would buy the whole business, but it's unlikely to be selling there. If you think about hundreds and hundreds of wonderful companies, I get all these managers that just got a CEO yesterday who called me, and they want to tell me about their business, and they imply their businesses, or they think their business is the most attractive investment in the world. It isn't the most attractive investment in the world. There are thousands of possible investments. And, the idea that all these managers are saying our stock is the most wonderful in the world is crazy. But it's our job to look at hundreds of things and in terms of marketable securities, buy what we think are the most attractive ones among the ones we understand and like as businesses. And then occasionally we get the chance to buy an entire business. We never do that at a bargain price. It just doesn't happen. People don't do that. The stock market gives you bargain prices. Individual owners won't. But when we get a chance to do that at a fair price, we like doing it. We love building Berkshire with a bunch of businesses with favorable long-term economic characteristics. But the chance that any one of them, we aren't going to look for a given confectionery company and say, regardless of price, we're going to do this, because we don't do anything when the phrase regardless of price enters into the sentence. Charlie?
Yeah, I watched a man build up a business in Southern California, which was a wonderful business. And the time came to sell it, and he devoted his whole life to creating it. He sold it to a known crook who was obviously going to ruin the business just because he could get a slightly higher price. I think that's an insane way to live a life if you own a prosperous business. I think the better course is to sell to somebody you know is going to be a good steward of what you've created.
I'm Isaac Dimitrovsky from New York City. Mr. Buffett, it's great to be here. I've read that there were several times in your investing career when you were confident enough in one idea to put a lot of your money into it, say 25% or more. I believe a couple of those cases were American Express and the Washington Post in the 70s, and I've heard you discuss your thinking on those. But could you talk about any of the other times you've been confident enough to make such a big investment and what your thinking was in those cases?
Charlie and I have been confident enough, if we were only running our own net worth, I'm certain a very significant number of times, if you go over 50 years, there have been a lot of times when you'd have put at least 75% of your net worth into an idea, aren't there, Charlie?
Well, but 75% of your worth outside Berkshire has never been a very significant amount.
Well, but I'm going back. Let's just assume it was. Let's just assume you didn't have Berkshire in the picture. There have been times, I mean, we've seen all kinds of ideas we would have put 75% of our net worth in.
Warren, there have been times in my life when I've had more than 100% of my net worth invested in things.
That's because you had a friendly banker, and I didn't. No, there have been times, well, initially I had several times I had 75% of my net worth in one situation. There are situations you will see over a long period of time. I mean, you will see things that it would be a mistake if you're working with smaller sums. It would be a mistake not to have half your net worth in. I mean, you really do sometimes in securities see things that are lead pipe cinches, and you're not going to see them often, and they're not going to be talking about them on television or anything of the sort. But there will be some extraordinary things happen in a lifetime where you can put 75% of your net worth or something like that in a given situation. The problem has been the guys that have put 500% of their net worth in. I mean, I mean, if you look at, just take LTCM, very smart guys, very decent guys, some friends of mine, high grade, knew their business, but they put, maybe 25 times their net worth into things that were a cinch if they hadn't have gone in that heavily. I mean, they were in things that had to converge, but they didn't get to play out the hand. But if they'd had 100% of their net worth in them, it would have worked out fine. If they'd had 200% of their net worth in it, it would have worked out fine. But they instead went to, maybe 2,500% or something like that. So there are stocks. I mean, actually, there's quite a few people in this room that have close to 100% of their net worth in Berkshire, and some of them had it for 40 or more years. Berkshire was not in the cinch category. It was in the strong probability category, I think. But I saw things in 2002 in the junk bond field. I saw things in the equity markets. If you could have bought Cap Cities with Tom Murphy running it in 1974, it was selling at a third or a fourth what the properties were worth, and you had the best manager in the world running the place, and you had a business that was pretty damn good, even if the manager wasn't. You could have put 100% of your net worth in there and not worried. You could have put 100% of your net worth in Coca-Cola earlier than when we bought it, but certainly around the time we bought it, and that would not have been a dangerous position. It'd be far more dangerous to do a whole bunch of other things that brokers were recommending to people. Charlie, you want to comment?
Yeah, the students of America go to these elite business schools and law schools, and they learn corporate finance the way it's now taught, and investment management is the way it's now taught. And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice. But that's, there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor, diversify as to time they purchase their equities and as to the equities they purchase. That's crazy for somebody that really knows what they're doing. And you will find opportunities that if you put 20% of your net worth in it, you have wasted the opportunity of a lifetime, in terms of not really loading up. And we've had the chance to do that way in our past when we were working with small sums of money. We'll never get a chance to do that working with the kinds of money that Berkshire does. We try to load up on things, and there will be markets when we get a chance to from time to time, but very seldom do we get to buy as much of any good idea as we would like to. Go to number one.
Mr. Buffett and Mr. Munger, my name is Guy Pope, and I'm from Portland, Oregon. I enjoyed the cartoon this morning, and I'd like to expand on that. I, too, like the idea of both of you serving as a single term as the President of the United States. Hypothetically, let's say, Mr. Buffett, you served the first term, Mr. Munger, you served the second term.
I think the other way around's better, but go ahead.
Each of you, please name 3 difficult policy decisions you would implement during your term to better the country.
Well, Charlie's going to serve the first term, so I'm going to let him name his 3.
I think that one takes us so far afield that I think it's asking too much. 3 perfect solutions to the major problem of mankind from each of us in a few minutes. We've just barely managed to stagger through life as well as we have, and I don't think we're quite up to it.
We probably have a massive federal program for retirement homes, actually. I would probably do something about the tax system that would change things so that the super rich paid a little more and the middle class paid a little less. But that might be why you'd prefer to have Charlie serve first. Number 5.
Hi, my name is Timothy Ferris. I am a guest lecturer at Princeton University twice a year. And I'd like to touch on an earlier question about investing with small sums of money. I'd like to ask both of you, if you were 30 years old again and had your first $1 million in the bank, how would you invest it, assuming you're not a full-time investor, you have another full-time job, you can cover your expenses with other savings for about 18 months, no dependents, and it'd be really helpful for my students, for myself and others here, if you could be as specific as possible about asset classes, percentages, whatever you're willing to offer.
Well, I'll be very simple. Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard, somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor, and I would feel that unless bought during a strong bull market, which this hasn't been, I would feel that that was going to outperform to a degree bonds under current conditions over a long period of time, and then I'd forget it and go back to work. Charlie?
Yeah, it's in the nature of things that you aren't going to have a whole lot of screamingly successful professional investors. You've got a great horde of professionals taking croupiers' profits out of the system, most of them by pretending to be professional investors. And that is in the nature of things too. But if you don't have any rational prospects of being a very skilled professional investor, well, of course you should compromise on some simple thing like an index fund.
Yeah, and that you will not get that advice from anybody because nobody gets paid to give you that advice. And so you will have all kinds of people telling you how much better they can do for you than that, and how if you just give them a wrap fee or give them commissions or whatever it may be, that they will do better, but they won't do better. On average, if 1,000 other people like you do the same thing, that group of 1,000 will do worse if they listen to the people that make pitches at them. And in the end, why should you expect? I mean, you'll get a perfectly decent return over a 30 or 40-year period by doing what I suggest. And why should you expect more than that when you don't bring anything to the party? The salesman will tell you that you'll get it, but you won't.
I would give you another word of warning. Do not judge stockbrokers generally by the ones you meet at this meeting. We attract some of the most honorable, intelligent stockbrokers in the world. They are not representative of the class.
The politician in him just came out. Okay, we'll do one more and then we'll break for lunch. Number 7.
Good morning. My name is Tim Pham. I'm from Austin, Texas. For my children, I would like to hear from both of you as far as the temptation to keeping up with the Joneses. And can you give them advice that they can live by with respect to frugality, debt, and work ethic?
Yeah, just tell them to keep up with the Buffetts. Well, Charlie and I have always been big fans of living within your income, and if you do that, you'll have a whole lot more income later on. And I think they will, to a considerable extent, not a perfect extent, they will follow the example of their parents. I mean, if their parents are coveting, every possession of their neighbor, or trying to figure out ways to increase their cost of living without necessarily their standard of living, the kids are likely to pick up on it. But now you can get the reverse effect. If you get too tough with them, they go crazy later on. But people make that election. And incidentally, there are plenty of people that I don't advise to save. I mean, if you're struggling along and making a reasonable income and you have a job with a 401k being put aside for you and you have Social Security, who's to say whether it's better to defer $1 of expenditure on your family on a trip to Disneyland or something that they'll get enormous enjoyment out of, so that when you're 75 you can have a 30-foot boat instead of a 20-foot boat. I mean, there are choices, and there are advantages to spending money in various forms for your family when it's young, and giving them various forms of enjoyment or education or whatever it may be. So I don't advocate I may practice, but I don't advocate extreme frugality. And I don't say that it's always better to be saving 10% of your income instead of 5% of your income. I think it's crazy to be spending 105% of your income, and I think that that leads to all kinds of problems, and I get letters from people every day that have experienced those problems. But in the end, if you want to have an internal scorecard. I mean, you are not a better person or a worse person because you live a different kind of life than your neighbor. You live a life that is true to yourself. Charlie?
Yeah, it's obviously the best method to train your children to provide the proper example.
I think we're hearing a child that didn't get that advice.
Yeah. But of course, even if you do provide the proper example, it's likely not to work.
It's new.
Some of the time, anyway.
It's new now. We'll take about a 30 to 40-minute break. We'll come back. Some of those who are in the other room, we always have some openings here after lunch, so you might be able to move into the main room. We'll reconvene. We'll say at 12:45. We'll go till 3 o'clock. My cousin Bill Buffett will be out at the Bookworm signing books about my grandfather. And I look forward to seeing you in a few minutes. Thanks.
Harry Bagai, San Francisco. Mr. Buffett, I was reading recently in Fortune magazine that when you invested $500 million in PetroChina back in 2001 or 2002, all you did was read the annual report. Now, I was thinking that most professional investors with the kind of resources that you have would have liked to have done a lot more research and talk to management, maybe regulators, et cetera, et cetera. The question I have is what is it that you look for when you're reading an annual report like that? How is it that you were able to and did make an investment purely on the back of reading that report?
Yeah, well, it was in 2002 and 2003, and the report came out in the spring, and I read it, and that's the only thing I ever did. I never contacted any management. I never got a brokerage report. I never asked for anybody's opinion. But what I did do was I came to the conclusion that the company, and it's not hard to understand crude oil production and refining and marketing and the chemical operation they have. I mean, you can do the same thing with Exxon or BP or any of them, and I do that with all. I look at them. And I came to the conclusion it's worth $100 billion, and then I checked the price and it was selling for $35 billion roughly. What's the sense of talking to management? I mean, basically, if you talk to management of almost every company, they'll say they think their stock's so wonderful, buy, and they'll give you all the good stuff and skip over things that it just doesn't make any difference. Now, if I thought the company was worth $40 billion and had been selling for $35 billion, then at that point you have to start trying to refine your analysis more. But there's no reason to refine your analysis. I mean, I didn't need to know whether it was worth $97 billion or $103 billion if I was buying it at $35 billion. So any further refining of analysis would be a waste of time when what I should be doing is buying the stock. So we really like things that you don't have to carry out to 3 decimal places. If you have to carry it out to 3 decimal places, it's not a good idea. It was something like PetroChina. It's like if somebody walked in the door here and they weighed somewhere between 300 and 350 pounds, I might not know how much they weigh, but I would know they were fat. That's all I'm looking for, is something that's financially fat. And whether PetroChina weighed $95 billion or $105 billion didn't make much difference. It was selling for $35 billion. If it had been selling for 90, it would have made a difference. So if you can't make a decision on something like PetroChina off the figures, forget about going further. And that's basically what we did. It's a straightforward report, just like reading just like reading Chevrons or ConocoPhillips or anything like that, just as informative. We're going to learn more, by going out and deciding whether you thought they've got one huge field in China, whether the life of it was 13 years or 14 years or something of the sort. They should hit you between the eyes. Charlie?
Yeah, I would argue that we have lower due diligence expenses than anybody else in America. and that we have had less trouble because we had less expense. I know of an investment operation in America that pays over $200 billion a year to its...
200 million.
200
million.
Yes, 200 million, pardon me, to every year to its accountants, a lot to help them with due diligence.
Hi, Mr. Buffett. My name is Matthew Millard. I'm from Norman, Oklahoma. And
we'll forgive that as Nebraskans.
That's okay, thank you. I've been a long-time Berkshire shareholder since I was 16. Really like the company, really like your investment style, buy and hold forever, kind of beyond the grave. But my question actually had to do with, do you know and believe in Jesus Christ and have a personal relationship with him?
No, I'm an agnostic, and I grew up in a religious household, and if you'd asked that question to my mother or father, you'd have gotten a different answer. But and I'm a true agnostic. I'm not closer to either a theist or an atheist. I simply don't know, and maybe someday I'll know, and maybe someday I won't. But that's the nature of being an. Charlie?
I don't want to talk about my religion.
Okay, well. Being an agnostic, I don't have to talk about my religion. It's very simple. Obviously, I have no opinion on anybody else's religion because that's the nature of being an agnostic. So I wish everybody well in their own. Number 11.
Hello. Good afternoon, Warren, Charlie. I want to thank you for hosting this annual meeting. My name is James Young from East Brunswick, New Jersey. I don't want to sound morbid, but my question is, once you two are gone and Warren's stock is placed in trust and slowly forced to be sold over the years, what safeguards are in place to prevent a hedge fund or LBO shops from joining together and acquiring Berkshire Hathaway and putting in play and breaking up this wonderful company and endangering the culture of this company?
Well, my stock would be sold over about a 12-year period after my death. During the time of settling the estate, it gets disposed of in the same manner as presently, and then it gets on a time clock. So that takes a lot of time. I may live a little longer even than now, but even if that started now, you would be dealing, I hope, with a company that had a market value much larger than even we presently have. And you'd still have large blocks of stock held by institutions or people that certainly had a similar philosophy. There's no guarantee that if somebody wanted to try a $600 or $700 billion takeover, and it might be a lot larger than that if you go out a ways, that it can't be done. But I think it would be about as unlikely to happen in the case of Berkshire as any company I can think of in the world. It can't happen at all, in effect, until sometime after I die. I mean, there'll be a lot of votes concentrated till that period. And like Charlie says, I've told there's this period after I die before this 10-year distribution period kicks in. So I've told my lawyer to make sure that my estate lasts for quite a while. And he says that's like telling your teenage son to have a normal sex life when you tell a lawyer that. But it'll be a long time. And like I say, if we do anything in the way of decent rates of compounding, you're really talking, one of the very largest companies in the United States. And I don't think I don't think there's going to be the LBO of General Electric or Exxon. And I think that it would be equally difficult with Berkshire. There's no 100% guarantee, however. Charlie?
Yeah, and besides, Warren doesn't plan to leave very early. I've heard him say several times when people ask him what he wants said at his funeral, and he always gives the same answer. He says he wants people to say that's the oldest looking corpse I ever saw.
And I'm unlikely to change my views on that subject. But thanks for asking. Number 12.
Hello, Mr. Buffett, Mr. Munger. My name is Kevin True from Chicago, Illinois. My question is this. You have identified 4 investment professionals who will, at some point in time, be running the portfolio for Berkshire Hathaway. What was the criteria that you used to select the 4 people, and what will be the criteria for evaluating them going forward?
Yeah, the criteria for selecting, I think we laid out pretty well in the 2006 annual report. We obviously look for people that have had pretty good records, but that criteria alone is nowhere near sufficient to come up with the candidates we want. I mean, we care enormously about human qualities, and we think we can make that judgment in some cases, and in some cases we can't. I mean, and it's no negative vote on people we skipped over. We just decided we didn't know whether they would be the right kind of person. We made an affirmative judgment on 4 as to both their ability and their integrity. And I would like to, there was one other item in here, I believe, which I think achieved a little added relevance in the last year. I said, we therefore need someone genetically programmed to recognize and avoid serious risks, and then I put in italics, including those never before experienced. And then I said, certain perils that lurk in investment strategies cannot be spotted by by use of the models commonly employed today by financial institutions. Well, I think that proved to be somewhat prophetic of what happened last year. All of these places had models. I mean, the major banks, the major investment banks, and they would meet weekly at a risk committee probably and go over their models, and all of the statistics would be printed in nice columns and everything. And they didn't have the faintest idea what risks they were involved. You really need, in the investment world, someone very solid, someone you trust, reasonable analytical skills, but you also need someone that actually can contemplate problems that haven't popped up yet, but which are starting to become possibilities in terms of new financial instruments or new behaviors in markets and that sort of thing. And that's a rare quality. I mean, that inability to envision something that doesn't show up in your past model, can be fatal. And Charlie and I spend a lot of time thinking about things that could hit us out of the blue that other people don't include in their thinking. And we may miss some opportunities because of that, but we feel it's essential when managing other people's money, or for that matter, managing our own money. So I would say that you might go back and read the 2006 annual report again, but those are the criteria we're looking for, and we have identified as being met by the 4 people we're thinking about. Charlie?
Yeah, you can see how risk averse Berkshire is. In the first place, we try and behave in a way so that no rational person is going to worry about our credit. And after we've done that, and done it for many years, we also behave in a way that if the world suddenly didn't like our credit, we wouldn't even notice it for months, because we have such liquidity and are so unlikely to be unable to be pressured by anybody. That double layering of protection against risk is like breathing around Berkshire. It's just part of the culture. And the alternative culture is just the opposite. You call a man the chief risk officer, but often he is functioning as a guy that makes you feel good while you do dumb things. So he's like the Delphic oracle that convinced the Persian king to attack somebody or other. I mean, he's just a dumb soothsayer. And how can a guy be dumb when he's got a PhD and he can do all this advanced math? Well, you can but you can. It's very well. All you've got to do is crave system and computation so much that you torture reality into fitting some model, mathematical model, which really doesn't match. particularly under extreme conditions. And then because of this work that you're putting into everything and these computations about daily trading risk and so forth, you feel confident that you've clobbered the risk, but you haven't. You've just clobbered up your own head.
I'll even applaud that one. We really want to run Berkshire so that if the world isn't working tomorrow the way it's working today, and it's working in a way nobody expected, that we don't have a problem. We do not want to be dependent on anybody or anything else, and yet we want to keep doing things. So we found a way to. We think we found a way to do that. It may give up some of them. Well, it obviously gives up earning higher returns 99% of the time, and maybe 99.9% of the time. Obviously, we could have run Berkshire with more leverage over the years than we have, but we wouldn't have slept as well, and we wouldn't feel comfortable. We have a lot of people in this room that have almost all their net worth in Berkshire, including me, and we wouldn't feel comfortable running a business that way. Why do it? I mean, it just doesn't make any sense to us to be exposed to ruin and disgrace and embarrassment and for something that's not that meaningful. If we can earn a decent return on capital, what's an extra percentage point? It just isn't that important. So we will always try to behave in a way that A, is not dependent on anybody else evaluating the risk except for us. It cannot be farmed out. And you've seen what happened to some institutions where the management thought they were farming it out. And, if that means a reasonable return instead of a slightly unreasonable return, we just accept it. Number two.
Hello, Mr. Buffett. Hello, Mr. Munger. My name is Burkhard Wittek, and I'm from Munich, Germany. I would like to get back to your point that as a professional investor, one should be able to act quickly and decisively. That means being able to know what the intrinsic value is and to act within a day or within an hour if the market offers an opportunity. My question is, how large is the universe of companies which you have in your head whose intrinsic value you know, where you would be able to act within a day or two if the market offered an attractive price to you? And secondly, how come you suddenly invest in Southern Korea or China?
Yeah, we can act. Our immediate decision is whether we can figure what's being offered out to us or not. I mean, there's a go, no-go signal, and Charlie and I are often thought to be rude when we think we're just being polite and not wasting the other person's time. So as they start mid-sentence in their first conversation with us, we just say, forget it. And Charlie's pretty good at that, and I'm picking it up. We know very, very, very early in the conversation whether somebody's talking about something that there's any chance is actionable by us. And we don't worry about the ones we miss. We want to make sure that we don't waste any time thinking about things that when we get all through thinking about them, we're not going to know enough to make the decision on. So we just rule those out, and that rules a lot of things out. But then if it gets through a couple of these filters and makes it into an area where it says this is something that we know enough about to make a decision on, we're ready to move right then. So we make decisions. We can make a decision in 5 minutes very easily. I mean, it just is not that complicated. Now, we know about a number of businesses and industries, and there's a lot of businesses and industries we don't know anything about. We know about a lot of things about certain kinds of bonds, and we know some. There's a variety of things we know about, and it's nice if we can expand that universe of knowledge. But the most important thing is that anything that gets through is in an area of knowledge. And the truth is, if we can't make a decision in 5 minutes, we can't make it in 5 months. We're not going to learn enough in the following 5 months to make up for the fact that we went in deficient in the first place. So it's just not a problem around Berkshire. If we get a call and somebody says either they've got a business for sale, or that's what we're going to get on the calls, or if I'm reading a paper or a magazine or an annual report or a 10K, and I look at a price and there's a significant differential between price and value, we move right then. And Charlie and I don't need to talk to each other about it. I mean, we both think the same way, and we have generally similar spheres of knowledge. Charlie?
Oh, the answer to your question is we can make a lot of decisions about a lot of things very fast and very easily, and we're unusual in that respect. And the reason we're able to do that is there's such an enormous other lot of things that we won't allow ourselves to think about at all. It's just that simple. I mean, I have a little phrase when people make pitches to me, and about halfway through the first sentence I say, we don't do startups. They don't exist. Well, if you blot out startups, there's a whole layer of complexity that goes out of your life. And we've got other little blotter out systems. And using those, we finally find out that what remains is still a pretty large territory that we can handle. You think that's fair, Warren?
Yeah. And there are an awful lot of giveaways that people in the first sentence or two throw out that, we just know we aren't, it isn't going to work. And we waste I would say, we waste a lot of time, but we waste it on things we want to waste our time on. And we're very selective about that, and then we're good at it. We waste a lot of time. But we're not going to waste it on things we don't want to waste it on. Number 3.
Hello, my name is Andre Stolte. I came from New York City, and I'm thrilled to be here. I'm greatly inspired by you. We follow you in our analyzed business class in New York City, a small group of small investors. And
there are human rights violations in the climate.
My question is, would you or have you considered asking Coca-Cola to withdraw sponsorship from the Beijing Olympics in light of the immense human rights violations in Tibet, possibly inspiring a new business model that would value humanitarian interest as well as monetary interest?
Yeah, I personally, I personally think that the Olympics, and I hope they are, conducted forever with everybody participating. I think that personally it's a mistake to start deciding what this country should be allowed and this country shouldn't be allowed. Now, I think it's very hard to grade a couple hundred countries that might be participating according to how their behavior was. I mean, we didn't let women vote in the United States, until 1920. So we went 140 or so, 130 years. And I would say that was a great human rights violation, but I would have hated to see the United States banned from the Olympics, in the years prior to that because of that. So I just think it's a terrible mistake to try and get into something. The Olympics are a wonderful event. I think the more people participate in them, the better. And I think that on balance, they contribute to a better world over time. So I would not start getting punitive about it. But I understand your motives on it, and thank you. Charlie?
Well, Warren understates my position.
I usually understate his position. This is a matter of strong opinion.
And I would say to you people who are distressed by imperfections in China, ask yourself the question, is China more or less imperfect as the decades have gone by? And the answer is China's moving in the right direction. And as long as that's happening, I think it's a great mistake to just pick the worst thing about somebody you don't like and obsess about it.
Yeah, the U.S. has moved in the right direction over years. Our Constitution said blacks were 3/5 of a person. I mean, we've moved a long way, and we're far from perfection. But I think you do better with people that you're working with to, if they're going in the right direction, largely to encourage them. You may want to nudge them a bit, but I don't think the Olympics is the right way to do it. Let's go to number 5.
Good afternoon. I'm Elizabeth Baird from Apopka, Florida. I would like to thank you for this wonderful opportunity to learn so much more about finances and at the same time have a wonderful time. It's been fun.
That's great.
I teach at Valencia Community College in Orlando, Florida. I teach office administration and business. I applaud my students for investing in themselves by enrolling in college. I also want to stress financial independence and financial freedom. I do this by telling them that slow and steady wins the race. Also, good, sound financial management, and then the law of reciprocity. What else should I be doing to lead them to make sound financial decisions and to have a happy, sound financial life?
I'm ready to hire your entire class right now. Well, I think you're giving us some very good advice. I think that the most important investment you can make is in yourself. I mean, very, very, very few people get anything like their potential horsepower translated into the actual horsepower of their output in life. And potential exceeds realization to just an enormous factor with so many people. And one illustration you might try with your class, I tell them this when I talk to high school groups. Just imagine that you're 16 and I was going to give you a car of your choice today, any car you wanted to pick. But there was one catch attached to it. It was the only car you were going to get in the rest of your life. So you had to make it last there. You can pick out the fanciest one you want, a Maserati, whatever it might be. How would you treat it? Well, of course, you would read the owner's manual about 5 times before you turned the key in the ignition. You'd keep it garaged. Any little rust you would get taken care of immediately. You'd change the oil twice as often as you were supposed to because you know it has to last a lifetime. And then I tell the students, and you get one body and one mind, and it's going to have to last you a lifetime, and you better treat it the same way, and you better start treating it right now because it doesn't do you any good to start worrying about that when you're 50 or 60 and the rust, that little speck of rust, is turned into something big. So anything your students do to invest in their mind and body, particularly your mind. We didn't work too hard on the bodies around here, but you know, it pays off. It pays off in an extraordinary way. Your best asset is your own self, and you can become, to an enormous degree, the person you want to be. When I get classes in universities, I just ask them to imagine they were going to buy one of their classmates to own 10% of for the rest of their life. Which one would they pick? They wouldn't pick the one with the highest IQ or necessarily the one with the highest grades. They pick the person that's going to be effective. And the reason people are effective is because other people want to work with them. They want to be around them. And other people they don't want to be around. And those are qualities that an individual picks up. Being generous, being humorous, being on time, not claiming credit for more than you do, but rather than less than you, helping out other people. All kinds of human qualities that turn other people on, and then there's things that turn on people off. And those are habits, and they're the habits that you pick up when they're the age of your students. The habits they have today will follow them throughout life, so why not have good ones? So that's the only message I would give your students.
Well, I've got a specific suggestion that answers your specific question. I would add to that extensive repertoire of yours by teaching them to avoid being manipulated to their disadvantage by vendors and by lenders, using the standard tricks of the vendor and lender trade. And you couldn't start with a better book than Cialdini's Influence. And I think Bob Cialdini, who's a shareholder, is here somewhere in this audience. And so I have a new textbook that I suggest you add to your class which is Cialdini's influence, and he's just got a new book that's coming out and for sale in Omaha today, I think, for the first time, and that's called Yes. So here's two books that I suggest you add to your class.
Hi, Mr. Buffett and Mr. Munger. My name is Niharika Neela, and I'm from Houston, Texas. I'm in 7th grade, and I'm 12 years old. I was wondering why you do not believe in dividends, Mr. Buffett, when your mentor, Ben Graham, believed in dividends. He influenced you in so many ways, but why weren't you influenced into believing in dividends? Thank you.
Well, I had to show a little individuality in some respect. Well, the answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. And there are many businesses. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If we do that, the shareholder, whether they're taxable or whether they're not taxable, whether they're a foundation or whether they're living on income even, they are better off if we retain the money. Because if they were going to get $1 in dividends and it became worth $1.10 or $1.20 in market value immediately on a present value basis, they're better off selling a small percentage of their stock and realizing the required amount that way, and they will have more money when they get all through doing that than if we paid it in dividends. But if the time comes, and it will come someday, if the time comes when we don't think we can use the money effectively to create more than $1 of market value per dollar retained, then it should be paid out. And like I say, we do that individually within Berkshire, but because we have this ability to redistribute money in a tax-efficient way within the company, we probably had more reason to retain all of our earnings. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire. We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any dividends. Costco paid a very small. Did they pay any dividend for a while, Charlie? Or,
while they were growing very rapidly, they paid no dividend, and finally they are paying one. Berkshire's policy is much the same. Warren has always planned on paying large dividends out of Berkshire, and he does it in the mode of St. Augustine when he said, "God give me chastity, but not yet."
Right. I've always admired that. Number 7.
Gentlemen, my name is Jim James from Minnesota, actually Minneapolis. And clearly you've inspired 38,000 people here today. Books have been written about you, not solely for your financial prowess, but because of the people you are. Could you share 2 or 3 influences on you, those kinds of people, educators, who have shaped your thinking on life and on investing? Thank you.
Well, I think the biggest educator, certainly in my case, initially was my father. I think probably Charlie would say the same thing. I think it's very, very, very important who you marry, and I've been lucky there. And those are great teachers. And of course, I had Ben Graham, I had Dave Dodd. I've learned from all kinds of people who've written books over the years. I've just devoured those, and you're picking up things here and there. Charlie learned a lot from Ben Franklin, obviously. Many think people think Ben Franklin learned a lot from Charlie, but we both learned a few things from my grandfather at the grocery store. But your I tell the students, the most important job you have, as a is being the teacher to your children. I mean, you're the ultimate teacher. You're this great big thing, you provide warmth and food and everything else, and they're learning about the world, and they're not going to change a lot of that when they get into graduate school or sometime. So it's and you don't get any rewind button. You don't get to do it twice. So you have to do your best as a teacher, and you teach by what you do, not by what you say, with these young things. And by the time they've got the place where they're entering a formal school, they probably learn more from you than they're ever going to learn from anybody else. Charlie?
Well, I would argue that differing people learn in differing ways. With me, I was put together by nature to learn from reading. If some guy's talking to me, he's telling me something I don't know, I don't want to know, I already know, or he's doing it too slow or too fast. In reading, I can learn what I want at the speed that works. So to me, reading is what works for my nature. And to all of you who are all like me, I say, welcome. It's a nice fraternity.
You probably learn more from your father than you learn from all the reading you did, don't you think? In terms of actually forming you?
Well, yes. And my father was the type that always did hit more than his share of the work and took more than his share of the risk. And all that kind of example was, of course, very helpful, and you learn it better from a person close to you. But in terms of the conceptual stuff, I'd say I learned it from books. Now, those are fathers in a different sense, the people who wrote the books.
Yeah, well, one book obviously changed my whole financial life when by happenstance, probably, I picked it up. I can't even remember why I bought it back when I was in school. But if you just keep picking up enough books, you'll find something. You'll learn a lot. And I used to go through the Omaha Public Library and just go down the shelves. But it's kind of an inefficient way, maybe, of doing it. But if you read 20 books on a subject you've got an interest in, you're going to learn one hell of a lot. You don't know which one you're going to learn it in, though. So I would take having, if you get the right parents, you're very lucky. You're very, very lucky, and it's better than going to the right school or anything of the sort. And if you get the right spouse, you've just doubled down. Number 10.
Hello, I'm Clement Lowe from Toronto, Canada. I'd like to thank you for the wonderful meeting. And I think I've learned a lot more here in a few hours than many, many more hours during university days. My question is, you have invested in drug companies such as Johnson & Johnson and Sanofi. How do you evaluate the pipeline of these companies and know if their competitive advantage is indeed enduring?
Well, that's a good question. And unlike many businesses, when we invest in something like pharma, we don't know the answer on the pipeline, and it'll be a different pipeline anyway 5 years from now. So we don't know whether Pfizer or Merck, or you name it, Johnson & Johnson, we don't know which of those will come up with a blockbuster commercial drug 3 or 4 years from now, and we don't try to assess it. What we do feel is if we have a group of those companies bought at reasonable prices, that overall pharma will do well, maybe not quite as well as they have in the past, but they're doing something enormously important. They're doing something that should offer chances for decent profits over time. And we do not pick one by one. I could not tell you what's the number one potential in the pipeline of a J&J or Sanofi or whatever, which one you want to name. So I think in that area, actually a group approach makes sense, which is not the way we would go at the banks or something of that sort. I do think if you buy pharma stocks at a reasonable multiple, a group of them, you'll probably do okay 5 or 10 years from now. I would not know how to pick the specific winner. Charlie?
Well, you speak from position where you have a monopoly of our joint knowledge about pharmacology.
We will move on to number 12. He gets cranky later in the day. And we're just about to the end, but we can take a couple more.
My name is Shao. I'm coming from Wuxi, China. Thank you, Mr. Buffet and Ms. Mungo, for your unbiased opinion on China and Olympics. To support your observation, we have a group of chairmen and CEOs from Chinese public companies to come to Omaha and try to learn from the best of how public companies should be run.
Thank you.
Quick question. We observed that you made a quick trade on PetroChina, not a typical buy and hold approach you do on investment. Our question is, when it comes to selling PetroChina, what comes to your mind? And what suggestions you may have to these group of executives? There are positive forces in China, and we welcome everyone to Olympics.
Thank you. And I met Dr. Gao from the China Investment Corp here a few months ago. I was very impressed by him. I had lunch with him here in Omaha. The PetroChina decision, just as we made it to buy it at a valuation overall of 35 or to 40 billion when we thought it was worth 100 billion, when oil was at $70 a barrel, roughly 75. I figured the value was about 275 or 300 billion, and we could sell it at that price. And we no longer felt it was undervalued compared to other oil companies, so we sold our stock. Now, incidentally, right after we sold it, it went up dramatically because, as you know, they issued A shares in China, and it became very popular. And at one time, PetroChina became the most valuable company in the world measured by market value, which would have come as an enormous surprise to investors 7 or 8 years early. So they've done a terrific job. And if it went down to a price that we thought was a discount, significant discount to its valuation, we would buy PetroChina again. In terms of, I'm not so sure we don't have a lot to learn from the Chinese in terms of business currently, more than they have to learn from us. I'm not sure I would want some of our practices to spread to China. It's a remarkable society, what's going on there now. And I did go to Dalian not long ago, and I must have traveled for 45 minutes from the center of town out to our plant there, and I just saw really hundreds of plants, factories that have developed in recent years. The economy is, the Chinese people are starting to realize their potential. I mean, what it amounted to is you had, for centuries, you had people of lots of ability, but a system that did not unleash their potential. And now it's starting to be unleashed, and that's why you're getting very substantial GDP growth per capita, and I think it'll continue. I would just look for the best practices in American industry as you see them and copy them, and I would discard the rest. And I think it's how you learn about human behavior. If you look at an effective individual, you try to figure out why they're effective. Why is Don Keogh or why are Tom Murphy, why are they so effective? Why do people want to be around them? Why are they leaders? Why do people love them? And you see certain human qualities, and you should copy those qualities. And when you see some guy that should have everything going for him and everybody in town hates him, you want to make sure you don't have any of those qualities. Well, I would do the same thing in terms of looking at businesses in this country and try and look for what I admire and emulate it, and make sure that try very hard not to let the things that you find over here that are distasteful to you creep into your own system. Charlie?
Well, I hope you'll go back to China and tell them that you met at least one fellow that really approves the Confucius emphasis on reverence for elderly males.
I think you should dig yourself out of that by including females too, Charlie.
That wasn't Confucius's idea.
Oh, okay. No reason why you can't modify it. Okay, we'll have one more.